Anyways, all right, let's get on with it. Okay. What happens when a central bank has an asset purchase program? And it's hard to, okay? See, when you go through school, you get taught how to always label your chart. So now we need a chart that looks like this. This is the, what would this be? This would be the quantity of money and the value of money. I guess we'll put value. It's actually price, but the value, okay? Quantity of money and value, okay? Okay. So, okay, when you have $1 and it can buy you a Lamborghini, you don't need much money. Okay. So we'll call this 1. And then, so you have this like all the way through the quantity, right? 2, 3, 4, 5, 6, 7, 8. So what I'm trying to show you is to the right is more and up is more as well. The value of money. So we'll say that the value of $1 or the purchasing power or whatever, and we can do the quantity of money. How much money is in the economy? Okay, and then you have downward slope. Let's do this in a different color though. Downward sloping curve. Okay. Because the less purchasing power or value of your dollar or whatever your currency is, the more quantity you're going to need, right? All right. And then, of course, the opposite of is the supply. Oops. Okay. So now you got your supply and demand equation. So what we're talking about now is the central bank going out and buying stuff with their money. Okay. Now, you have to change this because we're talking about central banks. We're talking about an economy. We're not talking about, let's say, microeconomic stuff. We're talking about macros. So now we have to adjust this because when it comes to money, there's this amount of money in the economy. It's not upward sloping, it's vertical because there is $5.25 trillion dollars, like the number of dollars or whatever the number is. There's a fixed amount. There's that amount of money right now. And therefore, based on that, there is a purchasing power of whatever that is. Okay? That creates a value. So we'll call this 1, 2, 3, 4, 5, 6. So as the value goes up, you don't need as much quantity, and as quantity increases, right, you have a value associated with that. So the way that we label this, now I got to get yet another color, and I think I need to go a little thinner. You have V1, or let's call it V star, equilibrium, okay? And we'll call this Q star, quantity equilibrium, okay? All right, so now what we're talking about is what happens when the central bank buys some assets. You get it? So what the central bank does is they create some money. They actually go onto a computer. They don't print money. That's what the Treasury does. Whether it's the Fed or the ECB or somebody else, Bank of Japan, it could be the Central Bank of Peru, okay? What they do is they create some money and they shift, okay, the quantity of money. Think about it. They create some money to buy the asset. The asset goes on the balance sheet, okay? But the balance sheet has to balance, so the liability is there's money in circulation. And in particular, globally, right? It doesn't have to be globally. If they're buying gold from somewhere, then it might be, but they might be buying local treasuries, for example, okay? So now if they're buying local assets, local treasuries, local bonds, which are very common, central banks are doing this now. They didn't do it 20 years ago, but now they do. So they buy domestic assets, they put the assets on the balance sheet, and they give whoever sold the assets money. So what happens is there's a new amount. Dude, that's supposed to be vertical. This is terrible. Okay, there's a new quantity of money. Okay, so, and I'm shocked I didn't label this properly. Oh my God. Supply 1, and that's supposed to be demand 1. Oh my God, I almost got an A- on this. Okay, and so now we got to go here. So now we're at supply 2. Supply has shifted to the right. So the central bank has created money, gave the seller of whatever asset they bought it. Remember, the asset belonged to somebody. So they gave the asset seller money, and now the asset sits on the balance sheet. Okay, the asset sits on the asset side of the balance sheet. So they have an asset, but they gave up money. Okay, so the quantity of money went from, or in this case, the supply of money. You can do Q star or Q1 and Q2. But anyways, we went from 5.25 quantity to 7, right? So we went up, the quantity went up, but what happened to the value? Okay, we went from V star to V2. We went from Q star to Q2. The quantity of money went up, and the purchasing power, the value of the currency went down. We went from this yellow level of the old equilibrium to the crimson level at the new equilibrium. So this shifted down, the value, the purchasing power, the price of the currency dropped as they increased the supply of money, which they created to buy the asset. So now their currency is weaker than it used to be, but they might be an exporting nation. They could be Europe, they could be Japan, they could be India, they could be China. And these are all countries that I've spoken about recently with the assumption that you know this. Like, this is basic, right? So this is in, I think, video number, 4 of the fundamentals course. Okay? In video number 3, you learn how to manage your bank as a commercial bank manager. I have to teach you how to manage your balance sheet. And once you understand your balance sheet management as a commercial banker, then you can understand how to manage your balance sheet as a central banker. But the thing is, a central banker has a much different intent. Their intent is to change the value of the currency, not to manage a balance sheet. A commercial banker is trying to make money. A central banker is trying to manage the economy through adjusting or manipulating the value of the money. So right now, the ECB is upset that the euro is getting strong. Remember, the euro isn't getting strong because Europe is good or it has inflation or any of that. It's getting strong simply because the US dollar is getting weak. And I told you this, that this would get to be a problem. We have spoken about it recently, and I remember giving you the story about me hanging out with the, I think he was like the vice president or CEO of BMW North America. We're sitting out in Connecticut, just shooting the breeze, and I brought up the fact I was a currency trader and how he must just be getting slaughtered on the strong euro, and he's like, yeah, we actually lose money by selling BMWs. So he's like, this year we're not sponsoring this racing event. So this is real world stuff. But I'm assuming that you know this stuff because it's like in the first 5 hours of the fundamentals course, right? This is basic. So that's what happens. Okay, that's why. So you're like, well, why would the ECB want to buy some assets and increase their balance sheet? Why does the Fed want to do it? Why does the Bank of Japan have like 300% of GDP on their balance sheet? Like, why do they do this? Because their intent is to go from equilibrium 1 to equilibrium 2, lower the value of their currency and give them a competitive advantage globally as an exporting economy. Wow. So that's really cool.